The euro is the currency that everyone has been watching today. It experienced its largest one-day slide this month on the back of weaker Eurozone data and stronger US data. Volatility in the FX market for the past few weeks has been relatively low, so today's move is a breath of fresh air for anyone who's looking for some big moves. However, I would take it with a grain of salt because we do have the Good Friday holiday on Friday, so U.S. markets are closed. And then on Monday is Easter Monday in many parts of the world where other markets will be halted for trading. So continuation and follow through is unlikely, but the sell-off that we've seen in the euro today is consistent with the general fundamental outlook and trends for the currency as well as the economy. Today, Eurozone data basically flashed warning signs for the region. We've known for some time that the Eurozone economy has been weakening. Italy is at the brink of recession. The European Central Bank has basically rolled out a third targeted long-term refinancing operation. They said they have no plans to raise interest rates this year and are generally dovish. So data was likely to confirm that. And on Thursday, we had the Eurozone PMIs. The Eurozone PMIs showed a further contraction in economic activity in the Eurozone, with the overall index dropping to its lowest level since March 2014. So that's going to reinforce the concerns about the Eurozone economy. German bond yields have been in negative territory, in and out of it, and if you contrast that with the fact that U.S. interest rates are, well above German levels, the general yield spread is putting downward pressure on the euro-dollar. Now, in addition to softer Eurozone data, on Thursday we also had extremely healthy U.S. retail sales report, where U.S. consumer spending basically beat even the most optimistic economists' expectations. Based upon this data, which is partly due to the recovery in gas prices, but also due to stronger underlying demand, this is basically telling us that the slowdown that we had in the U.S. economy at the start of the year could be temporary. Now, it is still too soon to declare victory, and I don't think the Federal Reserve is going to be swayed by 1 month of data. They're going to want to see this trend continue. But it was good news, and it was overwhelmingly positive data when you look at the numbers. Jobless claims also fell to their lowest levels in the U.S. in 50 years. So that means the labor market is tight, which should encourage further spending in the months ahead. So we've got good U.S. data, weak Eurozone data, and a central bank where the Fed is just thinking about delaying the rate hike, whereas the ECB is thinking about more stimulus. So all in, that should put additional pressure on the euro-dollar. 113 was rejected soundly this past week, and I think the pair will ultimately make its way towards 110.